1929, dreams shattered in a day, the dark days of Wall Street. On the morning of October 24, 1929, the weather in New York City was cold but sunny. As always, people on Wall Street were routinely heading to work. Who could have known that on this day, they would witness the beginning of one of the greatest stock market disasters in history? Within hours, thousands of investors would gather outside the New York Stock Exchange, watching silently and anxiously as their life savings vanished in seconds. This was not just a day when savings evaporated, it was a day when the dreams, confidence, and future of an entire generation were shattered. This video is the story of the Great Depression of 1929. How the crisis started, why it grew so massive, and most importantly, how it affected the lives of real people and investors. The beginning of the Great Depression actually goes back years before 1929. The 1920s in America were called the Roaring Twenties. The First World War had ended, the economy was booming, and new technologies, automobiles, radio, electricity, were changing lives. Consumer culture was growing rapidly, and in this climate of prosperity, ordinary Americans began flocking to the stock market. Every day, newspapers ran headlines about how shoeshine boys, telephone operators, and even maids were getting rich in the stock market. Everyone was convinced that making money was just that easy. People even started investing with borrowed money. Through a system called margin buying, they purchased stocks by borrowing far more than their actual capital. This multiplied their gains, but it also created an immense risk. Just days before the crash, the country's famous economist Irving Fisher declared that stock prices had reached a permanently high plateau. No one believed a downturn could ever come. October 24, 1929, recorded in history as Black Thursday. As soon as the market opened, stock prices began moving sharply downward. In a single day, the stock market lost 11% of its value. Panic erupted among the investors on the trading floor, brokers moved in terror, phones rang relentlessly, and telegraph lines couldn't handle the capacity. As bad news spread across the city, creditors demanded that investors repay their debts immediately. This triggered a massive wave of panic selling. Everyone was trying to sell their stocks, but there were almost no buyers. By mid-November, the nation's stocks had lost 33% of their value. The Monday and Tuesday that followed, October 28 and 29, Black Monday and Black Tuesday, made the situation even more dire. The Dow Jones Index, which had reached a peak of 381 points just a month earlier, began hitting rock bottom with these consecutive drops. It would ultimately plummet to 41 points by 1932, representing a staggering 89% loss in stock value. Outside Wall Street, thousands of investors gathered in the streets. They stood silently in front of the stock exchange, watching their savings vanish into thin air. This scene left deep scars on the memories of those who witnessed it, people just staring in silence, shocked, motionless, and exhausted. During that period, rumors quickly spread that brokers were jumping from windows on Wall Street following the crash. In fact, a construction worker working on top of a building was once watched in terror by the crowd below, who mistook him for a suicidal broker. But the truth is, research indicates that the suicide rate in New York at that time was no higher than in the months before the crisis. This window-jumping myth arose from the dark humor and anxiety-filled rumors of the era. Yet, real tragedies did happen, they just occurred silently, out of public sight. A woman who had worked for a brokerage firm for many years ended her life due to the exhaustion caused by overwork. A trader who suffered massive losses in the stock market ended his life by jumping from the window of his lawyer's office. Far away, a man who lost his entire fortune left behind only a one-sentence note. These people were not numbers, they were individual lives, families, and dreams. A stock market crash alone would not create such a massive depression, but the enormous domino effect it triggered did. Banks could not collect the loans they had given to investors and businesses. As a result, they ran out of cash to pay their own depositors. By 1933, 11,000 of the country's 25,000 banks had gone bankrupt. Once ordinary citizens lost hope in the future, they stopped spending, consumption dropped by 20% in 1930. This reduced demand, caused more businesses to go bankrupt, and unemployment skyrocketed. While the number of unemployed was under 3 million in 1929, it reached 12.8 million by 1933, which meant nearly 25% of the workforce was unemployed. Shantytowns made of cardboard and scrap materials, known as Hoovervilles, emerged in the streets, named after President Hoover, who was seen as inadequate in providing aid. People lost their homes, and breadlines became the symbol of cities. People who were once self-sufficient were now desperate for a bowl of soup. This crisis was not limited to America. It crossed the ocean to Europe. The financial collapse in Germany, in particular, fueled political crises, laying the groundwork that would drag the world into a much greater catastrophe within a decade, World War II. The 1929 stock market crash and the ensuing Great Depression changed world history forever. The Depression lasted until 1941, when America entered World War II. Yet, as every dark night has its dawn, something positive was born from this wreckage. The financial system was completely rebuilt. In 1933 and 1934, the government enacted new laws to regulate the banking system and protect investors. The Glass-Steagall Act separated commercial banking from investment banking. Institutions that were the ancestors of today's Securities and Exchange Commission, SEC, were established, aiming to ensure such disasters would never happen again. The biggest lesson of 1929 for investors was this: markets do not rise forever, and overconfidence, especially confidence built on debt, can collapse even the most solid-looking systems. Irving Fisher's words of a permanently high plateau became etched in history as one of the most famous wrong predictions of all time. The Great Depression of 1929 showed investors that the stock market was not just made of numbers. Behind every chart line, there are real people, real families, and real dreams. Most of today's modern financial regulations, banking audits, investor protection laws, were born directly out of this disaster. So, will history repeat itself? In our next video, we will examine the 2008 global financial crisis, and see how, 80 years after 1929, the world repeated the exact same mistakes. If you enjoyed this video, don't forget to subscribe to The Stock Market Historian, Borsa Terahisi, and like the video. See you in the next video. Goodbye.